Hey guys, in this video we're just going to do a quick breakdown of some of the key earnings reports that happened in the market over the last week. Before getting into it, if you like this type of content, please subscribe to the channel, give this video a big thumbs up, it really helps with the YouTube algorithm a lot, and would love to hear any thoughts you have on any of these stocks or any other companies that have recently reported in the comments down below. Okay, so this earnings week, we didn't have a ton of companies' earnings, but we had some really interesting ones. So I'm going to highlight day by day which companies that I found interesting. I did a preview video earlier in the week, but just wanted to go back and see how those earnings ended up going and what the impact on the stock price was. The first one I'll go over is Tilray, which is a marijuana company. These companies make no money, have no margins, and they've just been going straight down. So I was really interested to see how they did after this quarterly report. The stock this week is down about 10% or 9% rather, but down 60% in the last year, down 92% over the last 3 or 4 years here. So it's just been a huge source of value loss. And that didn't stop this week with earnings. So if we look into their earnings report, their revenues, let's call it flat, 145 million versus 144 million. Profits, surprise, they lost gross profits. You know that's never a good sign when you're losing on a gross profit standpoint, not even after you include all of the other expenses. Margins were negative 8%. So adjusted gross margin rose to 30%. Yeah, I don't know about all these adjustments. Like when I think of adjustments, I think of 1 year over another year. There's like one-time items. This company's never been profitable, so it's just constantly adjustments. Unfortunately, adjustments don't get reimbursed to your bank account at the end of the quarter. So just not a not an unexpectedly bad quarter, but a bad quarter in my opinion. To not be growing on top line, to still be burning money on the bottom line, no real line of sight to anything changing, at least on the Canadian business, which is where lots of this company operates in. The other thing that they announced is they acquired the other 50% of Hexocorp, which is another company that they've recently invested in to try to improve profitability through scale. Once again, don't have any money, so it's just going to come with dilution of shares or more debt on the balance sheet, which is going to hamper their ability to grow into the future. So this is one that I am staying far, 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 far away from. I have no interest in this company. It was interesting to see their earnings, though. Going into Tuesday, I wanted to take a look at CarMax just to get a sense for how the economy was doing versus how analysts were expecting. So CarMax is like a rental and wholesale company for used cars. Pretty big company, now almost $11 billion, but their stock price went up almost 8% this week. So they had better earnings than expected. If we just look at the summary on CNBC in the morning trading, shares of the company went up 7% on the earnings report. They earned 44 cents a share, almost doubling the estimate of 24 cents. So they had a pretty good quarter from a profitability standpoint. With that being said, the company still had revenues down 26% versus last year. Retail used unit sales on a unit basis were down double digits as well. So not a great operating quarter. The units that were bought were down over 20% as well. And even EPS, it was 44 cents, which was significantly higher than expected. But on the versus year ago, it was under 50% of what they did last year. So on the year, earnings were down over 50% to $3 a share. So, on a multiple basis, that doesn't seem too good when the stock's trading at $70. It's like 23 times earnings. I think there's a lot higher quality, less volatile companies with a lot higher of a moat that trade for less than 23 times earnings. So was interesting to see this stock pop on this guidance and this performance. It just seems expectations were so low. I still don't understand why this company is deserving a multiple in the 20s, given where they operate and how the business has been doing. So that's one that I'm not interested in pursuing, but was once again interesting to see how the market reacted, see what the earnings were. Going on to Wednesday here. Wednesday, there was LVMH, which is a luxury goods company that was reporting. They have an ADR on the New York Stock Exchange, I think, but I like to look at their European um, stock just because they report their dollars in euros, so it's a lot easier to follow. Looking at LVMH, another stock that popped this week behind earnings, up over 6%. The market cap is over 430 billion euros now. If we look at their results by region, they grew across the board. So these are really, really strong numbers. It just really goes to show the difference in economic impact for the middle class versus the upper class and the upper class. As lots of these goods are thousands and thousands of dollars for a bag or a watch, but where they're seeing robust growth. So Asia, excluding Japan, probably lots of China in there, up 14%. Japan up 34%, US up 8%, Europe up 24%. Even in Europe, where they're having a lot of economic hardships with inflation and everything to do with what's going on there, grew 24% versus last year. So total company up 17%, an unbelievable number. I'm shocked by that number. For those of you who didn't see my video earlier in the week, just on this company more broadly, trying to get to the earlier slide here. All right, I'll come back to that. But one of the titles, or lots of titles, but Birkin bag maker sees pickup in U.S. demand for pricey products. It goes on to just say down here that they're extremely optimistic in their growth in the U.S. and Chinese markets, which are obviously the two biggest economies in the world. The company now trades for 460 billion US dollars, and they're up 30% on the year. So even if I just go year to date, being up 30% on the year for a company with a market cap almost $500 billion is insane. So this company's performed a lot better than lots of people expected them to. Okay, and we're back. This is just a breakdown of their, still having some technical difficulties, of their revenue, but it's just supposed to be showcasing how diversified this company is. They have, there we go. They have a quarter of their business in the US, 36% in Asia, excluding Japan, 7% in Japan, 14% Europe, 13% other markets, 7% France. So very diversified business that they're running here, which I think helps them get that high earnings multiple that they are currently trading at. So on this one, don't own the stock. I wish I bought it earlier in the year. Trades at a bit too high of a multiple for me, but really, really strong performance that they posted this quarter. So I can kind of understand it. The next stock that I wanted to get into a bit more was Delta. But just to show you on the earnings grid here, Delta was the only real stock on Thursday that piqued my interest. But Delta, as a company, went up earlier in the week and then down the back half of the week. So about flat on the week. Their earnings were really interesting because they didn't post great quarterly earnings, okay? Their March quarter earnings were down. They lost EPS. There was lots of expenses and issues with some of the pilot contract negotiations and stuff like that. They didn't have a ton of free cash flow, and they have still a lot of debt on their business, on their balance sheet rather, from COVID. But the stock stabilized, and I think at one point was up behind reiterating strong 2023 outlook of $5 to $6 per share and having more than $2 billion in free cash flow. So looking at this company, $5 to $6 a share means this company's trading at like 6 times earnings for 2023 and about 10 times free cash flow. So pretty reasonable valuation on 2023 as long as they're able to hit those earnings. But overall, obviously airlines tend to trade pretty cheap because it's extremely cyclical. But people are moving around, traveling around, seeing family, going on vacation, so on and so forth. So obviously they have to work on their balance sheet. It's obviously the risk if another pandemic situation happens, these companies get absolutely crushed. But it seems like they're going to be really profitable this year and trading at fair valuation. So maybe one that you may want to consider. Okay, so the holy grail of this week's earnings was definitely Friday. We had a bunch of the big banks reporting. JP Morgan Chase probably the one that people were watching the most, and then United Health Group as well. So I was really looking forward to Friday, especially with all the banking crises that have happened, just to get a look under the cover at what's happening at those big banks. The first one was JP Morgan Chase, up 10% on the week. So this was a big sigh of relief for the entire banking sector. Just looking at some of the beat here, their adjusted EPS came in at $4.30 versus $3.40 estimate. Revenue also came in huge, 39 billion versus 36 billion, so about a 10% beat there. Bank profited over $12.5 billion. So just on a sheer scale, that is so much money to be making in a 3-month span for the bank. So overall, this bank just performed really well. Net income, just going through exactly where they allocated their income. They had a payout of a third of their capital or their income. They bought back shares. They issued dividends. So they're reinvesting or repatriating money back to shareholders, which is always great to see. Hopefully, as they continue to grow, they will increase those metrics. Their balance sheet, deposits, everything else looked relatively healthy. Loans up, deposits slightly down, probably moving to higher interest accounts and stuff like that. ROTCE at 23%, that which looks strong, and then capital ratios also looked strong as well. So the bank overall looks like it's not deteriorating. It's in good position. They posted good EPS, good forecast, relatively good sentiment, and that's why it's up 10% on the week. United Health Group, this stock was flat on the week, but it actually went down on the earnings by a couple percent. So just looking at the summary here from that morning in trading, the health insurance provider stock fell 3% on investor concerns over how some 2024 policy changes will impact their Medicare Advantage plan profits in the near term. The decline in share came after UNH surpassed estimates on top and bottom line and boosted its full year guidance. So that was really interesting. They beat on top line, they beat on bottom line, they boosted guidance. Stock still went down because of policy. So when you're in this space of regulated space, you always have that hanging over your head as a concern. In terms of their earnings, they guided about $25 a share, which was up from $24 a share. And if we just look at their stock, obviously, $25 a share, they're trading at 20 to 21 times current year earnings. So not too expensive of a stock, given how large it is and it's playing in a growing sector. You do get a little bit of a dividend there too. So this is one that, while definitely not trading like cheap or anything like that, is probably fairly valued. Maybe one I put on my watch list to see if it dips further. But overall, was surprised that this one didn't go up more. With that being said, I don't fully understand, or I don't have full perspective over this policy change that may impact some of their Medicare insurance business for next year. So that's it, guys. Tried to go through this one pretty quick for you. But these are some of the breakdowns of the key earnings reports from the last week in the market. If you like this kind of content, please subscribe to the channel. Give me a big thumbs up. If you made it this far in the video, would love to hear from you in the comments. Lots of people don't make it to the end, so it's great to hear from those who do. And I'll see you guys in the next one. Thanks.